All right, here we go. Market panic again. You know, it's really funny how people never change, behavior never changes. I got the same people now, same people coming on here, making comments, same comments they were making back in November and December of last year when the market was in a correction. What'd I say back then? You had to buy that correction. Why did I say that? I said basically two things. Number one, fiscal support to the economy was at record levels. Number two, bank credit, loans and leases, bank asset accumulation and growth, bank capital, all expanding. That was a barometer of economic conditions. I said that last November, I said that last December. You had all the same people as now posting up comments, the market's gonna crash, this is it, Mike, strap in your seatbelts, you're wrong, da 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 da. I said we're gonna go make new all-time highs. We went to make new all-time highs. Now, I believe it was on May 2nd, I told my subscribers we're probably gonna have a market correction. So we entered into a market correction. We got the same people right now spewing out those same comments. Strap on your seatbelt, Mike. You're completely wrong. You're leading everybody down the path to slaughter. The market's going to crash. The market's going to collapse. It's the end of the world, all this stuff. I will repeat, the same conditions are in place. Record fiscal support, bank credit expansion, loans and leads. In some cases, some of these bank metrics are at levels, well, nominally they're at all-time record levels, but the growth rate, if you want to look at the second derivative, which is the growth rate, maybe that's more important. I think it is important because it did actually signal the correction in October, September, October of last year when the growth rates in these bank metrics really started to slow down, but they've been accelerating. And in some cases now you're looking at 2-year highs, 3-year highs, 3.5, 4-year highs in the growth rate. Not just the nominal level. Like the nominal level, the total amount of loans outstanding, that sort of thing, the total amount of bank assets, that always goes up. All right, because the economy grows, more assets are added to the economy, etc. That, you know, it's important. I'm not saying it's not, but if you look at the growth rate, that gives you deeper information. And that's happening again now. So the same people, it's funny to me. It's funny to me. I will say that without hesitation. And I'm taking your money, okay? I'm taking your money. I have patience. I could wait out a stock market correction. I know when to buy into a correction. And again, let me revisit a point that I made recently, that I'm not a perma bull. When the conditions come together where I know that the economy is about to go into a contraction, whether that's a short-term contraction or a long-term contraction, because I will know when that happens. I know what drives these conditions. I'm not throwing darts at a dartboard. Although I could and still make money. You can't, but I can because I have the mental game to do that. But everything here is based on science. Everything here is based on science. You people are guessing. Science means when you look up in the sky and the sun is there and the sun sets and it goes away, I don't believe that the sun has gone away forever. No, because science tells me the earth is making a rotation and the sun will rise again. But you people, the way you think is that the sun has gone away forever. It'll never come back because you don't think in a scientific way. I do. That's the difference. It is absolutely the difference. I approach this as science. The things I look at and the insights I derive from those things and the connections I make, that is science. So like when the sun sets, I don't panic and think like it'll never come back away, like the sun has flown away to another solar system or to some other part of the universe. I know it's coming back, so I wait until the morning when it comes back up again. And how do I know that? I know that because it is science, just as I know that the same thing, or the same approach is applied here. It's called the scientific method. It's not guessing, it's not conjecture, it's not art, it's science. So that makes it easy for me. Now, for a person who does not think in a scientific fashion, it makes it very, very hard. I would say it makes it impossible. Now, I will say this, for a person who does think in a scientific fashion, like me, I will admit that sometimes it gets frustrating, but the frustration is born out of impatience. And that is a little chink maybe in the mental game armor that I have. For me, it's an observation that says, still got to work on that, still got to work on that. And when I have people who come to me who get excited all the time, excited, I'm saying in a negative way, like nervous excited, I try to calm them down and I try to make them see that they have to work on that aspect of their mental game. And I would say, I don't know, maybe 1 out of 100 ends up doing it and they go on to great success. Most of them, the rest of the 99 out of 100, they quit and they go looking for the system fairy. So that's what it is. It's a really easy game. We complicate it for ourselves. Now let me just make a quick comment about the market and bond yields. I've been writing a lot about this. I've been sending out a lot of emails on the bond yield. The drop in bond yields is completely technical and has nothing to do with any impending recession. I have been absolutely, unequivocally on the record about this. We'll come back and revisit my statement, and if I'm wrong, if we go into a recession, I absolutely say to all of you out there who are critics of mine, just bombard me with the negative comments. But we'll come back and we'll see if we go into recession. And by technical, the decline in yields, I don't mean it broke a chart line. I mean there's two things going on here. Number one is the debt ceiling, which has restricted the ability of the government to issue new bonds. Okay? And of course, bonds are the most ubiquitous asset in the whole entire world and the most important collateral. Everybody needs them. And number two, the decline in bank reserves, which has been engineered by the Fed, correctly I should say. The banks have been asking for a decline in reserves for a long time. They don't need so many reserves. The decline in bank reserves necessarily causes the banks to have to replace those assets. Yes, reserves are bank assets. They're tier 1 bank assets. They have to replace those assets with other tier 1 bank assets. And the most important tier 1 asset after reserves are treasuries. So they have to, because they have to meet stress test requirements that the Fed imposes. So when reserves come down, the banks have no choice. They have to buy treasuries to replace those tier 1 assets. And now you have a limit on the supply of treasuries because of the debt ceiling, and that's creating this squeeze. It has nothing to do with a recession. As a matter of fact, the data is pretty strong, as I've been telling you. If you look at the banking metrics again, I'll say it again, very, very strong. All right, everybody, science.